How I would invest $1 million. All right, we're going to read this article, and I'm sure we're going to have Finn contribute how he would invest $1 million because he's fighting with Powell. So let's read this. My man, I think Alan sent this to me actually today. So November 23rd, 2020, Logan Kane, macro portfolio strategy, real estate author. All right. Asking how to invest $1 million is a classic job interview question at hedge funds and asset management firms. The question is known to throw candidates for a loop. My goal in writing this is to show the simplest way to beat the S&P 500 with a minimal time investment. Look at some academic research-backed strategies that passed the test of time. Congrats, you've won the lottery. You didn't win the grand prize, but you have a month to decide how you invest $1 million. What would you do? What would you do? I'm approaching the question from my experience with the financial markets. I'd personally prefer to invest the money in real estate, but that's a business that most readers could not replicate. To this point, my goals for this exercise are simple. To beat the S&P on an absolute and risk-adjusted basis, support a 5% annual withdrawal rate adjusted for inflation, spend less than 1 hour per week managing the portfolio. A lot of investors have limiting beliefs that they can't beat the market. They won't be able to retire. Well, those two things are not necessarily the same, but you can't beat the market and you can be able to retire. The way that the typical investor manages their money, these beliefs are often correct. You can do better, though. Well, how does he know what the typical investor does? I got some sunshine. It makes my face look weird. Without further ado, here's how I invest $1 million. Factor-based investing. Oh, geez, you got to be kidding me. The foundation of the strategy is to invest in index funds. Finance theory holds that your risk-adjusted return increases by the square root of number of independent investment opportunities that you can invest in. If you're starting to do square roots in your risk-adjusted returns on investing, you've jumped the shark. That's just silly. And this isn't math, man. The markets aren't mathematical. They're not. They're emotionally driven. That's just a fact. And there's stuff that comes into the markets that we cannot predict. And as such, there is no math, no science to market investing. In plain English, this means that the more broadly diversified, oh, by the way, right there, a hat of the tip to you Social Security people, not Social Security people, you Secret Service, duty, loyalty, honesty, courage, and justice. A tip of the hat. That means the more broadly diversified investors do better than concentrated ones on average. To improve your investment returns, you either need to improve the strengths of your forecast, like Buffett or Munger, or diversify more. Like Ray Dalio. The stance of a lot of hedge fund guys is that they don't diversify because they're smart. My opinion is that I diversify because I'm smart enough to know that what I don't know and can use leverage and diversification to paper over my lack of arcane accounting knowledge. The idea behind factor investing is that there are statistical factors that identify sources of risk and return. For example, research shows that companies that pay dividends have tended to outperform those that don't pay dividends. This is not rocket science, blah, blah, blah. All right. There are always lottery players out there who want to speculate on bankrupt companies and losers, so markets are resoundingly not efficient, whatever. Alpha. The iShares Edge and the iShares Edge, some are low volatility funds that play on the same idea. Finance theory holds that the volatility of a given stock rises when they get into financial distress. So owning low volatility ETFs is a way to guarantee that you own nothing you own will go bankrupt on your watch. Well, that doesn't make sense. The volatility of a given stock rises when they get into financial stress, which tells me that they have low volatility before they're in financial stress, which meant they could be in a low volatility ETF. That doesn't make any sense. ETFs is a way to guarantee that nothing you own will go bankrupt on your watch. How does it guarantee that? That's silly, man. I guess what they're saying is because when it hits financial stress, it gets volatile, i.e. goes down, so we'll sell it at that point. That doesn't make sense. The equal-weighted index shares is the NASDAQ, but equal-weighted is another idea somebody had written up in the Factor series. The theory that investors tend to plow money into companies at large, familiar, and popular. Well, there is something called... I used to own a bunch of Apple when it was trading around 10 to 12 earnings. Now it's at 31. I wish the new buyers the best of luck. All right, so that's okay. So basically what he's saying is when we equal-weighted index, I've talked about that a couple times here. The equal-weighted index got smoked by the market cap index last 10 years. Just all there is to it. Does that mean it will? I have no idea. All right, so but no, so he would buy 350,000 in these funds. Value investing. Most investors like to play value stocks with ETFs. My experience that ETFs are exceedingly bad at identifying good value stocks. I coordinate my value investing with somebody who writes about his value picks monthly here, mostly a buy and hold strategy. 100,000 in 10 stocks at a 5% yield, risk parity. All right. He's got PIMCO. I would put 500,000 in PIMCO bond ETF. This has got to be a leveraged. Traditionally, risk parity strategies would borrow money to buy stocks and long-term treasuries at the same time, and since they have negative mutual correlation, long-term positive returns, you can rebalance them periodically and historically, and can crush the S&P 500 this way. So basically, you're leveraging. Okay. For a primer, what I'm doing here, the quant strategy that's 20-5 against the S&P 500 since 1995. The idea that you have the ability to borrow at 0.5% and leverage futures to break the barrier of having 100% of your money. So like those 130-30 strategies, where you're literally leveraging 30% of your portfolio to get 130% market exposure. Have we not learned anything about leverage? So he put a 500,000 in PIMCO bond ETF. It's a good option, but it's more correlated with equities. Okay, I would additionally put 100,000 notional in gold and long-term treasuries. I ran a quick test and verified that using leverage to diversify resulted in a higher return than the S&P was similar. Okay. All right. So this portfolio can be safely leveraged up to 2-to-1 and would still have a risk profile similar to vanilla index funds. All right. So he's just leveraging. Okay, that bores me. And then he goes back to 2014. Okay. I mean, that's going back to 2014 to show you his return relative to 2014. So you can see he's got a total exposure of 1.75 million on $1 million account. And he's saying that Apple at a 31 PE is too high, too risky there. The above strategy returned close to 15% annualized before any withdrawal since 2013. There have been 2 bear markets since then. Well, they're tiny. The one in 18 was 19.4%. And the one in 2020, we got over in 33 days. That's how would I invest $1 million? I'd put 4 years of cash and CDs with a Ginnie Mae fund and the rest in BTI. Literally that simple. That don't get involved in the leverage, man. That's just don't. All right, we'll see ya.